Good afternoon, everybody. Thank you for attending our latest lender webinar in association today with Caroline from Pepper Money. Hi, Caroline.
Hi, Dale. Thank you very much for having me today.
Thank you for coming on board. So to our audience, Caroline will go through a number of slides to tell you about Pepper and what they can do and how Impact and Pepper work together. There is a question and answers option at the bottom of the screen here, so please do give us your questions and we'll try and answer those live. At the end of Caroline's presentation, I've got a few questions to ask anyway, but any other questions, do please feel free to ask away. So Caroline, over to you for the next 20 minutes and I'll mute myself and come back to you shortly. Thank you.
No, that's brilliant. Thank you. Right, let's get my screen up so everyone can see. Okay, perfect. Okay, so hello everybody. As Dale said, my name is Caroline Mirakian, Head of National Accounts at Pepper Money. Hope we're all keeping well on this glorious day. And before I begin, I just want to say a huge thank you for all listening. Really do appreciate how incredibly busy you all are right now. So for you to take time out of your incredibly busy diaries means a lot to us. And but I'm confident by the end of the session, we'll be able to add to your kit bag in terms of additional ways we can help more customers. And I would also like to say, finally, a huge thank you to Impact for arranging these sessions. As Dale said, we work really closely in partnership together. So, you know, whatever we can do to help you in any way, you know, we're more than happy to do so. Okay, so, right, let's go on with some more fun. So what I'll do is I'm going to start by discussing a specific segment of the specialist mortgage market, which I believe will become more and more talked about as people's finances change following the pandemic. And that is around the impaired credit market. I'll then seek to give you a brief overview of who Pepper Money are, just in case you're not aware of who they are, and then share some criteria with you on how Pepper Money may be able to help your customers from both a residential and a buy-to-let perspective, and then obviously open up the forum for any questions you may have for me. So let's begin by starting to look at the specialist market as a whole. So we've certainly started to see the specialist lending market grow over the past few years, as we can see on the slide here. The mainstream market will always play an important part in the mortgage industry, and we should not downplay their significance or importance. However, where customer circumstances are becoming more complex, there is a need for the specialist sector. And as we can see in the slide, the market is growing. Growth certainly driven by an increase in self-employed applicants with complex income streams. Growth in the credit impaired market and the credit immature market, so those first-time buyers with light credit profiles. Growth of the property types being lent on, such as HMOs, for example. And this growth has supported the growth in the intermediary share of mortgage distribution, with brokers now holding a 77% share of the market, which illustrates the power and recognised importance and value a broker can bring to transform their customers' financial circumstances. Now I would like to discuss a segment of the mortgage market, as I alluded to earlier, which I don't think is discussed enough in my opinion, but where a significant pool of borrowers do fall. And with a pandemic upon us, this segment is one which intermediaries cannot ill afford to ignore, particularly now when customers who may have been in the past mainstream find themselves falling into the specialist category, as prime lenders cannot help. And these customers fall into the impaired credit market. So, I mean, adverse, just to kind of cover off in this context, usually means obviously a customer with a poor credit record, such as CCJs, defaults, missed payments on credit, bankruptcy, or an ongoing or previous arrangement with creditors, be that arrangement formal or informal in nature, caused by all sorts of short-term issues which are out of the customer's control, such as through loss of earnings, divorce, illness, or bereavement, so affecting their ability to sadly service their debt. But I thought this slide would be quite interesting just to show you how big the adverse credit market is. So if we size up this opportunity, this August we carried out at Pepper our latest study in association with YouGov into the adverse credit mortgage market. It's the first wave of research since the country went into lockdown measures to combat COVID-19. And our research estimated that there are 6.81 million people considered to have adverse credit in the UK. And of these 6.81 million people, 16% say that they intend to purchase a property either to live in or let out in the next 12 months. And this equates to 1.09 million potential mortgage customers with adverse credit who may need the support of a broker in the next 12 months. Now, so it is clear that COVID-19 has had a significant impact on people's finances, particularly those who have experienced adverse credit within the last 3 years. Now, according to the research, 2.1 million people missed a credit payment in the last 6 months, and half of those people have missed several consecutive payments. Nearly half of people say that they did not have an agreed payment holiday in place when they missed these credit payments, and 75% of people who have missed payments without first agreeing a payment holiday are actually concerned that it will negatively impact their ability to get a mortgage in the future. More than a third of people who have adverse credit have also said that the amount of debt that they have has increased as a direct result of the pandemic, and 37% of people with adverse credit say their income had decreased. Now, of those with adverse credit whose income has decreased, 26% said it was because they were furloughed, 18% had lost income through self-employment, 17% had lost their job, 15% said their income was reduced by their employer, and 6% experienced a reduction in income as a result of being unwell and taking statutory sick pay. So what does this mean for us as an intermediary community? So this certainly illustrates the huge potential of customers who need to be spoken to and helped. 66% of adults with adverse credit said that they would seek advice from a mortgage broker, equating to 719,400 customers for brokers. But our latest research has showed that although a positive 45% of customers now reach out to a broker partner for financial help versus the previous 44% stat, there is still room for improvement, with 61% seeking advice only from friends and family, and 55% saying they would speak directly with their banks, which we know are likely to say no as they cannot help. And when it comes to finding a broker, 53% say that they would carry out online research. So if I could give you a couple of tips based on just these stats alone today, it would be, number one, if you have a website, update it. So let customers know what situations you can deal with. Maybe even get a logo of Step Change Debt Charity on there to highlight you can help such customers. And number two, let family and friends know your services, as well as keep in contact with your existing customer base, because they may not need you right this minute, but they may need you later. Now, in terms of the most common reasons why these people have experienced adverse credit, it appears that missed payments are certainly the most common form of adverse credit, with 75% of participants having missed a payment in the last 3 years. And what's significant is that 32% of people have missed a credit payment in the last 6 months. And also 14% of people have missed several consecutive payments in the last 6 months that have resulted in a default. Now, in terms of the amount of current outstanding debt, there has been a slight upward trend in the amount of debt held by adults with adverse credit in the last 3 years. In the last wave, 36% of the group said that they had debt of more than 5,000, and in this report, that number has increased to 40%. And finally, and I think the most hair-raising piece of information identified from our research was the misconception about the impact of adverse credit on the ability to successfully apply for a mortgage, which was demonstrated by incorrect attitudes to the impact of a CCJ. What this slide shows is that 27% of people surveyed thought that they would have to wait longer than 5 years to apply for a mortgage after being registered with a CCJ. And the reality is many lenders are now able to offer competitive mortgages to customers who have been registered with a CCJ as little as 6 months ago. And in reality, when we looked at it, just moving wrong slide, 48% of people were not impacted in their ability to get a mortgage, which again shows the misconception, and which is why it's really important to educate our customers as much as possible. So now on to some more fun. So who are Pepper Money and how can we help you in partnership with Impact? So for those of you who don't know us, we are a specialist lender. We've been around since 2015. In fact, we're actually a worldwide renowned lender, and in some countries such as Australia, we're actually classed as one of their top 5 lenders. And the aim of us setting up in the UK was to try and help customers who don't quite fit the mould of the high street lender. So whether that be through a failed credit score, recent blip on their file, or more severe adverse in the past. And we provide a range of residential buy-to-let and limited company buy-to-let products. And we try and work to provide solutions to those who we feel are underserved borrowers in the market. And as we saw in the very first slide, obviously there's an increased number of underserved borrowers, and the need is certainly increasing. We manually underwrite all our cases, and we do not credit score. So we really just do look at a customer's circumstances. Now, which of the customers can we help? I mean, this just gives you a range. So from first-time buyers, so those with young credit profiles needing high LTVs, the self-employed, so we will look at, for example, 1 year self-employed trading and their latest year used for affordability when trading 2 years or more. Contractors, daily rate times 5 times 46 weeks, and able to, as long as we're able to demonstrate a minimum 12 months history. Again, those with impaired credit, those with a little credit or too much credit, so a low credit score, later life borrowers, and obviously our lovely buy-to-let landlords. And also what I will say is, in addition, it's any customer really, anyone, and we are able to look at a variety of income sources. So for example, benefits and maintenance may be included as additional income. And for example, with company directors, add backs are accepted for limited company directors, including like pension contributions, car allowance, and use of home office to boost affordability. Just some sort of USPs on the residential side. So as alluded to earlier, we do not credit score, but we also don't auto cascade. So the product you see is the product you get. We can lend up to 85% loan to value, and the maximum term is 35 years. In terms of capital raising, we don't mind any capital raising purpose, as long as it's legal purposes, including business use, but sadly not business debt such as tax bills. Debt consolidation, we have no debt to income ratio. Earned income is accepted to the age of 75 years. In terms of interest only options, we will go up to 60% loan to value with no further stipulations to criteria. And sale of main residence is accepted as a repayment vehicle with no predefined minimum equity. Now, just to touch on a little bit more around where Pepper Money are able to help around adverse credit, because I do think this is an area where there'll be an increasing number of customers following the pandemic. So if you've never used Pepper Money, we do pride ourselves upon providing a transparent product range, and that is very, very simple to use. It's based upon the registration dates of the latest CCJ, default or secured missed payment. CCJs and defaults can be looked at so long as the customer's had none in the last 6 months. In terms of CCJs and defaults, they do not need to be satisfied, and we do not have a volume or a value limit as other lenders do, so that is worth knowing that. In terms of unsecured arrears, if a customer has a fixed term, we ask for none in the last 6 months. And if they have revolving credit, missed payments will be considered. In fact, some defaults can be ignored. For example, we can ignore 2 individual defaults up to and including £150 each, where these defaults relate to utility bills, communications or mail order providers. And then we also have, well, in terms of debt management plans, we will consider them up to 75% loan to value. Now, in terms of buy-to-let, I'll just give you a sweeping overview of our USPs on that too. So we will go up to 80% loan to value, and that includes first-time landlords and limited company buy-to-let. We do have a minimum gross income application request for buy-to-let, and that is £30,000. What I would say with that is it has to be primary source of income as opposed to primarily made up of rental. In terms of someone who has a background portfolio, if those properties are self-funding, we won't use them as part of our stress testing. So they're basically ignored for stress testing purposes. For a private or individual property, we will look at the 140% of the pay rate on 5-year fixed, and for a limited company, 125% of the pay rate on a 5-year fixed. An SPV can be set up day 1 with no minimum trading period required, and no cumulative loan to value gearing limit on a background portfolio. Now, what's also worth noting is that the market rental figures will be used as advised by the valuer rather than the rent received. So you can find scenarios where rent can be lower that's being received, but actually we will look at the higher amount. Now, this slide is probably my favourite slide of all, because right now its service is of absolute paramount importance, I think, in the market, particularly where capacity is concerned. We are, and I'm very confident to say, exceptional in our service. We are turning around dips within 4 hours and applications within 24. We have a service level web page which is on our website, and you'll see that everything is being turned around within less than 24 hours. So, and it's not because we're not getting much volume in; it's because we believe that we've got a service recipe of success. And what I mean by that is, if an application gets submitted to Impact, we have a case owner. In fact, they've got their own dedicated one because of the importance of the relationship that we recognise. But basically, that case owner, who's the underwriter or stroke mandate holder, will pick up the phone directly to Impact and literally understand that case. And walk through all the documents that are needed, as well as it'll be documented on the online mortgage portal. But what that will do is there won't be this unnecessary toing and froing of what documents are needed throughout the process, which we believe is probably our recipe for success on getting these cases swiftly through. So if you haven't thought about us, it is probably a real good consideration point. In terms of best support, we've also revised our website, because we've appreciated that obviously right now it's trying to get information really quickly and at ease. We do have a product finder on our system, and we've relaunched our knowledge centre with information, for example, as our adverse credit study. But to be honest, you do have the font of all knowledge Impact. So what I would do is I would pick up with them, because they work so closely with us. They know all our intricacies and all the stuff that you need to know. So in essence, you've got that, you've got the website as a second place to go. Now, just to kind of more or less sum up, I just want to give you, just to show you an example of the case study. But I think what this case study shows is that we understand that everything will not always be straightforward. So we approach every application with the intention to lend, regardless of customer credit conduct in the background, because we want to give everyone a fair chance of becoming a homeowner. So with Adam, he set up his own plumbing business. Now, although he never struggled to find work, a series of late and unpaid invoices in the business's infancy left him struggling to pay his own bills. And his credit report was littered with missed payments and eventually a default. Now, his problem was his business was growing through contracts, but he was unable to obtain an application from his current lender due to his credit history issues. But it was safe to say that, well, by coming to Pepper Money, we were able to secure a home for him. So it was all good in the end. Now, do we do what we say we do? As obviously I covered off the service piece earlier. This is just a couple of testimonials during COVID, how we've been able to turn around cases for our brokers in need. That's it. Thank you so much for your time. Really do appreciate it. And thank you, Impact, again for, well, Dale, for inviting me along.
Thank you, Caroline. It was really, really informative, and you can certainly see your passion with regards to presenting about Pepper. It's brilliant.
Yes.
That report is brilliant as well, with regards to the insights into the adverse side. And you've got 1.09 million adverse borrowers looking to buy a property in the next 12 months. And 66% of those people are looking for advice, which is brilliant. Are we doing enough to get to the end consumer so they actually know about Pepper Money, about the adverse that's available? You know, a lot of customers tend to bury their heads in the sand. What sort of advice can you give to brokers to get to these customers?
No, do you know what's a really interesting question, and it's one that we think about daily, because I don't think there are, you know, I think there's more we can do, and I do think it's about an education piece. It's kind of trying to juggle it right now, isn't it? I appreciate, you know, brokers out there, you know, we're constantly trying to juggle with all the inquiries that we're getting. But yeah, I do think education is certainly important. That's what we're trying to do at Pepper, is trying to put together some material that we are able to provide that can be given to customers. But I think for me, it's making sure that websites are updated, because as I alluded to earlier, quite a number of people do, you know, they're a little bit shy or afraid to talk about their circumstances. Yes, they may go to family and friends who then may say, well, why don't you go to your local bank which we know will decline or won't even look at it. And, you know, dare I say it, actually, there was somebody who mentioned, for example, even on the Martin Lewis website, there was like, why don't you go to your local bank? Well, we know again that that's not necessarily the right, you know, the right forum. So if a broker can make sure their websites are updated and just talk about it, just talk about, you know, to family and friends, what the you know, services they offer, because it is an incredible job that we do day in, day out, and we can help a lot of customers. And you know, if you are afraid of talking, is to pick up with you, because you see all these cases day in, day out, know all the lenders, you know how we operate, and actually, if you know, even if they can just help a customer by doing a referral over, that's, you know, that's all that can be asked for, because you're going to be able to help one customer. So
yeah, no, that's good advice. And I'll also add to that as well. I mean, there are opportunities with local press and local Facebook groups to do blogs. To do articles, to do case studies. You know, there's plenty of stuff out there at the moment where customers absolutely are crying out for advice and recommendation and help, like you said. Service is key, which is great, and you're well up the curve compared to some who might be 20 or 30 working days behind. One question I have been asked to ask you, how do you look at the self-employed in the current climate? Because obviously that's a pretty key point with regards to depending on their employed roles, or not their employed roles, but their career paths and so on.
You know, that's a really good question. So I'm really pleased to say, actually. So when we, so our stance is we will look at each case on its own merit. At the moment, we will accept 1 year self-employed trading. However, obviously, you know, right now, if you're looking at 1 year's accounts, it could be a little bit, you know, income could have dropped. So we will try and find out, you know, what's the next job, as it were, you know, what's the income projection now, and also to see historic performance in any shape or form to kind of get us to build a picture as to the sort of scenario. It's a really tricky one, but what I would say is we did put in at the very start of COVID a self-employed rule on the system to say, if you're self-employed, for this customer to literally, you know, for us to ask the inside leg measurement of a self-employed customer, dare I say it, and that would have been from bank statements to income proof, and you know, it even came down to industry being considered. Now I have to say, I'm delighted to say, but I think that, which is a really good sign, is we've removed that ruling now from the system.
Okay. So
we'll be able to assess self-employed in our existing criteria. Yes, there may be a couple more questions, but I don't think they will be as onerous or as painful, because obviously the way we see it, the market is buoyant and in the right direction. So
cool. One of the questions that come in is how do you differentiate between a missed payment and the default side? What's your criteria on that basis? And I think you go up to 85% now as well, don't you?
Yeah, we go up to 85%. So missed payment is
on the resi side.
Yeah, missed payment is literally just like a credit card blip or a utility blip, as opposed to a default which is registered against that record.
But no maximum, no value amount, no number of
no volume, no, yeah, and we can ignore some of them. So you know, if you do have questions, please feel free to, you know, to contact me or yourself, Dale, whatever, to just to go through it. But on our website, it's if you go on there as well, that there is a credit impaired credit policy criteria which breaks it down, but it's very, very easy. To be honest, we kind of embrace all that stuff. We kind of ignore it, as long as the customer at the end of the day can make that payment. Yeah, we're not afraid to look at it.
Talking about that, have you seen many mortgage payment holiday requests just recently?
No, actually. No. So at the start of this whole pandemic, we had probably about 37%, I think it was, of our customer portfolio who'd made requests. I think there was a lack of understanding, because actually quite a lot of people wanted it just as their, you know, as a safety net. And that's reduced to like 0.01% now, which shows that everyone's gone back and no one's really looking at it. Yes, you do have the odd person, and we're trying to look at it, but no, it seems to have been something that's kind of gone away, actually.
And it doesn't affect someone applying to Pepper if they've started paying back, or they've restarted paying their mortgage payments as taking a payment holiday?
Yeah, no, we will. If it does, to be honest, we'll probably, if it does come up, we'll probably, you know, if it was asked, we will find out, we'll ask about it, but no.
Okay. Just running out of time, got a question coming though. What's Pepper's views on a missed credit card payment that's gone on for 6 months on the bounce, i.e. 6 months missed, 6 months in arrears?
we'd want to know a little bit more about that, but we'd probably look at it because we do have a product for pepper sticks that's available. So
excellent.
Yeah.
Okay.
So yeah, happy to look at it.
And what's your views for the first quarter next year? What should we be getting excited, or are the
You know what,
lenders?
we
Are
are.
you lenders? Got volumes to lend and so on?
So we have a very ambitious growth plan, which is really, really good news, because we do see the opportunity in the market. I think we are, dare I say, going back to normal. I mean, obviously with the vaccine, whatever, but yes, no, we do see there's a massive opportunity. Yes, there's going to be a little bit of a rush, I do think, with the stamp duty levy and the Help to Buy changes that are going to be made. There's going to be a capacity issue there for quite a lot of customers, I think. But from an opportunity perspective, we see it as we're there to help, and we are going to be widening out our proposition. We're looking at potentially bringing out shared ownership, right to buy, help to buy, and different options to make sure that this proposition is as varied as possible to be able to help as many customers as possible. So yeah, no, we're really excited about it, actually. So
that's really good, because that sounds really positive, because we've seen recently some lenders actually withdrawing from those sectors of the market. So
no, we're looking to embrace it, so it's all good.
Brilliant. We've come to the end of our time. Caroline, brilliant. Thank you very much for your presentation, and thank you for taking my questions. Thank you, the audience, for watching. Hopefully you found that useful. We have recorded it, so it'll be on an email flyer on our website shortly. Like I said, every week we do one of these on a Wednesday around about the same time, so please do tune in and watch out for the next one. In the meantime, thank you again for watching, and hopefully we'll speak soon. Many thanks.
Thanks, Dale. Really appreciate it.
Cheers. Take care.